Hello, everybody, and welcome back to our third and final webinar on financials. This one's going to be the financial red flags, and Heather Waldenmayer is going to be our host for today. And Heather comes to us with over 20 years of experience in construction finance, bringing together her public accounting background, private industry expertise, and leadership in various construction industry organizations. Through Elevated Advisors, she helps contractors strengthen their accounting departments, improve financial reporting, and gain confidence in the numbers they share with banks, bonding companies, and stakeholders. So Heather is going to lead us today. There will be time for questions as usual. She will pause and give us breaks for questions, and so I will help us through that process as we move through the questions and move through the webinar today. So please feel free to ask questions in our Q&A, and then we'll get those questions answered as we move through the webinar. Again, I'd like to thank everybody for joining us and sticking with us through these webinars. It's been a lot of fun, and we certainly hope to take some of your comments to be able to create more of these webinars. So Heather, I'll let you take it away.
Awesome. Thank you so much, Kenda. Good afternoon, everyone, and thanks for that amazing introduction. As you heard in my bio, I have been working with construction contractors for most of my career. I am a CPA and a CCIFP, but even though I'm not in the public accounting space, I work more on like the private side with accounting teams internally at construction contractors. I often interface with sureties and banks as the users of the financial statements that I prepare for my clients. So our team supports companies by supplementing their accounting departments with highly trained industry-focused professionals, which hopefully gives their banks, sureties, and owners more confidence in the numbers. For those of you who have seen webinars or conferences of mine in the past, I want to just preface this by saying I do not subscribe to the 5 words or less per slide rule of thumb for PowerPoint presentations. I instead try to pack as much information into these slides as possible so that you can refer back to them in the future. So I may not speak to every point on the slides, but I do try to include a lot of information in hopes that when you have a chance and you're going back and maybe watching the replay, you have additional context. So today's presentation should actually be about 45 minutes to an hour of material. I know it's accounting and it can be rather dry, so I definitely don't want to belabor some of these points. So we have plenty of time for questions, as Kenda said. One of the biggest perks of participating in a webinar live is being able to ask questions that make the content more relevant to you. So please know that I have set aside plenty of time for you to kind of interact and ask any questions that you might have in terms of how you work with the financial statements that you're receiving from your clients. So if I'm going over anything and you have a question, please just use the Q&A feature as soon as it comes to you. I will be stopping at about 5 different times during the presentation for any Q&A. So today we're going to be looking at red flags in the financial statements through the lens of credit to try to help, kind of give us some context to, why we are often asked to provide financial statements and what those numbers are trying to say about risk, reliability, and company performance. So we're going to talk about how to read between the lines of financial statements and how to spot when profit is not translating into performance, and how to recognize when a balance sheet may or may not have long-term stability. And then we're also going to be looking at hidden variables. So those external or internal conditions that tell you whether or not a company's success is sustainable. So think of today as, kind of working to build your ability to interpret what the numbers are really saying about risk. I know that accounting is not the most exciting topic for a Thursday afternoon, so I wanted to make this section a little bit more fun by setting it to a bit of a soundtrack. And so today's theme was inspired by my favorite musical icon, This is someone who has toured the globe, sold out stadiums, and to millions and millions of fans across the world, with what many would call an iconic voice. And I know you are all probably guessing exactly who I am talking about, and that is Freddie Mercury. So today we're going to be talking about finding financial harmony. Yes, we're going to be talking about red flags, but we're also going to be talking about green flags and the ways that we can balance these to make our clients' deals make sense. So to do that, I kind of want to put all these red flags into context using the 5 C's of credit. And so, why financial information is so important to sureties. At the end of the day, you guys probably are more familiar with the 5 C's of credit than I am, but my goal is to kind of layer what types of financial data and what types of red flags we kind of associate with these different areas of risk. And no one company is perfect. I wish they were, but even the best companies, they're all a little bit of a combination between red flags and green flags. And that's kind of where this idea of finding financial harmony comes through. At the end of the day, our goal is to really make sure that the red flags don't outweigh the green flags. When I'm talking about red flags today, I'm not saying that a client is like intentionally doing something dishonest, illegal, or dangerous. I'm instead using red flag as a way to say something increases a company's risk profile. We can think of the whole client experience like a scale. On one side, we have the red flags, and on the other side, we have the green flags. The more green flags a client has, or the larger the green flags the client has, the more the scale is going to tip to the green side. And that is going to lower the client's risk overall. But when we start adding red flags, even small red flags, if we add enough of them, that might counter the weight of the green flag and the scale tips the other way, increasing the risk. So a really good client can have a number of small red flags, but those might not outweigh the really big green flags that they have. So just because red flags exist doesn't necessarily mean that a deal can't be done. Overall, these are just tools to evaluate the risk in the deal. Because at the end of the day, I know that you guys have a job to do. And that is hopefully to underwrite these clients. And at the start of the entire process is understanding who your client is and why they want to work with you, right? And so we're going to start with the first C of credit, and that's character. You guys know your clients best, whether it is someone that you've worked with for many, many years or someone that you just met, a new client. Your relationship is going to shape a lot about what you know about the character of the individuals that you're working with. But character also exists in the financial data. So the way that a company closes their books, who prepares the financial statements, how they respond to the questions that you ask, or those pieces of information that maybe you want more support for or to dive a little bit deeper into. These are all things that tell you whether the data can be relied upon. So before we even start talking about benchmarks and ratios and all kinds of ways to analyze the numbers, we have to start by assessing the character of those numbers. So the reliability of the financials depends on the people and the processes behind them. So we look for competence. That would be like, does the person who's putting these financial statements together understand generally accepted accounting principles or industry-specific accounting knowledge enough to be able to apply those rules correctly and consistently on a month-over-month basis, or however often you're receiving these financial statements? When you are reviewing the financials and you have questions, does the person that you are, kind of working with, are they able to answer those questions accurately or support it with backup? And does management know how their accounting system works, or are they relying solely on outside help? The next one is consistency. Are the accounting policies applied the same way each period? This is particularly important for those of you who get quarterly financial statements in addition to like a year-end review or a year-end financial. If clients are only booking certain things at the end of the year, when you're getting information on a quarterly basis, it's not going to necessarily be comparable because they're not doing the same things consistently. Or if they only do a WIP quarterly. If they're comparing July, which doesn't have a WIP, and they're comparing that to June, which does, there can be wild swings that have nothing to do with the company's performance, but really it's just because they booked one entry one month and they didn't do it another month. You want to kind of gather an understanding from them about whether or not they have a documented close process. Are they actually going through an effort to validate and reconcile their information on a consistent basis, or are they just printing a report out of their system whenever somebody asks for them? You want to look at the ownership. Who is signing off on the financials? Like, who is ultimately responsible for the financial statements? Does that person, everybody makes mistakes. I myself make mistakes. I know that that can be shocking, but it happens. Does that person own it? And do they correct those mistakes? Do they acknowledge those mistakes exist? Or do they kind of dance around it and pretend like, it didn't happen? That is going to show the character of not just the financials, but the people preparing it. And then kind of a big one, because you guys need the information when you need it. And if clients are promising information at certain points in time, is there accountability when deadlines or reconciliations are missed? And the last one is transparency. I think that this is one of the hardest things to try to convey to clients, and why it's so important for us to, be taking certain positions that we take from an accounting perspective, is because I think transparency is very important. There are a number of different ways the accounting rules give us to treat the exact same thing. And some clients like to take a very conservative approach. They like to way underplay how they're going to do, because they want to set themselves up to, hit their marks. They make themselves a very, very low bar. That is one way of going about it. It's overly conservative. There are other clients who are overly aggressive and they overpromise and they underdeliver. And this is particularly of importance with the construction contractors or anyone where you have estimates of future performance that impact current day performance. How transparent is the client when those estimates aren't going according to plan? Are they conservative? Are they aggressive? Or I like to say, do they land the plane on the runway? Not too far this way, not too far that way, but right in the right exact spot. And when an issue arises where they're not going to do the things that they estimated that they were going to do they communicate that early and set the right expectations or reset expectations? Or do they try to hide it? Do they only offer up that information when they've been asked? Those are all things that play into the transparency. And if you have someone who is always very aggressive in their estimates and they don't really like to come forward when their estimates aren't coming to fruition, you know that those financials might not have as much reliability as someone who is always right on the money and tells you if things aren't going according to plan. So these factors are all going to determine whether or not the story told by the financials is trustworthy. And so how do you validate this, right? Someone gives you financial statements and you want to know really quickly, are these okay to move forward with, or are these garbage? There are 4 quick checks that you can do to validate the reliability of the financials that you receive in 15 minutes or less. These are all such commonly requested items that I get asked for from Sureties that I now just include these in all of the internal financial statements that I provide to my clients. So these are totally things that you can and should be asking for. The first is the AR aging, the accounts receivable aging. The company should know who owes it money, right? Where is their dollars coming from? And they should know exactly who owes them and how much they owe. And they should be able to provide that breakdown to you. And that breakdown should reflect the balance that is on the balance sheet that they're providing to you. The company should also understand those incoming payments when they're sort of expecting it and kind of have their eye on the horizon as a means for them to understand their cash flow. So when you're looking at that AR aging, you should be able to ask them questions. I see those questions all the time about AR balances that are over 90 days old, because the risk there is that real? Is it going to get paid? Is that a mistake? Did someone put that on the books when it really shouldn't have been? These are all very reasonable things to kind of question in order to validate the financial statements as a whole. And clients should be very forthcoming about those old balances. If those balances are legitimate or truly expected to come, be paid in the future, they should have a clear understanding or explanation about why the balance is overdue. And it shouldn't really be like the routine. It should be a few outliers and not the whole AR aging. The next one is the accounts payable aging, and very similar. This is a listing of who the company owes money to and how much the company owes to its vendors. So the company A should know that. They should, have an idea of what they've kind of got outstanding to their various vendors, and they should not be trying to hide those expenses from sureties. They should be very forthcoming about cash flow issues or other reasons why they might not be able to pay their bills. And so this would be, again, looking at that AP aging and making sure that it agrees to the accounts payable balance on the balance sheet, and going through and looking at things that are old. If they're having a hard time paying their bills, asking those questions about why. Because if a client is not having cash flow issues, but AP is over 90 days or accounts payable is negative, like it's showing a negative IOU, that is a sign of poor record keeping. And all of this is just ways to try to suss out if the data in this financial is even good enough to kind of move on to the next phase. The next one, this is more for those who are doing we're working with the contractors, is the WIP schedule. Again, for, all industries kind of go through the same motions or have the same process, but construction contractors have this extra financial statement called the work in process schedule that Fariba talked about in section 2. And that financial statement needs to exist. And it should also reconcile to the income statement and the balance sheet. So your contractor clients should know exactly where their revenue is coming from each year. And sureties should be able to track a project through its life cycle. So that's a mechanism for you to kind of gauge their character and understand their estimating bias. So you should be able to see any job that was on the work in process schedule last year. It's got to be somewhere. It's either closed in the current year or it's open in the current year. They don't just vanish, right? So if they're being forthcoming about how well a job did or didn't do, then it will be presented to you on this WIP schedule. And then the over/under billings or the contract assets and contract liabilities, those adjustments from what they billed versus what their revenue on the percentage of completion, those adjustments are often very significant. And so if the client, they might have a WIP schedule of what their contract summary schedules, but if they are not recording that on a consistent basis, when you go to take your financials that they gave you and plug it into whatever model that you're using or software system or benchmarks that you're doing, you're trying to compare this company without the percentage of completion adjustment to companies that do have percentage of completion adjustments, and those numbers are not going to be comparable. And then the last one is just their month-end close process. So a very quick thing that you can do is you can look at the date of the financials that they gave you. When a company does the appropriate steps to close their books, that means like validating the numbers, checking, double checking, reconciling everything on the balance sheet to something outside of the company. So like a bank statement or some kind of report. The financials need to reflect a date that's reasonable for the client to have done those reconciliation steps. So if bank statements are available around the first of the month and a client gives you a February 15th financial statement, it's not likely that they have done those validation steps for that 15th period, right? Those 15 days. And so that's why you usually see the financial statements are dated at the end of the month. But I often have been referred clients where the thing that they gave the surety is like some random, random Tuesday afternoon that wasn't a month end. And that's a surefire clue to me that they probably haven't actually verified the information that they're providing. So even though you are not necessarily being asked to audit this information, you can test your client's discipline by evaluating these 4 factors very, very quickly. Because again, reliable financial statements are going to come from repeatable good habits. So when we're talking about character, we're not just talking about the owner's reputation. We're talking about the character of the entire financial system, their software system, the people who are putting these things together. These signals are going to tell you whether the numbers can be trusted or whether a company might be masking issues below the surface, intentionally or unintentionally, just because they don't understand the rules of accounting. But either way, there could be issues lurking underneath the surface. And again, red flags don't automatically mean something's wrong, but they do signal higher risk and less reliability, or at a minimum, things that you want to ask more questions about. Green flags, on the other hand, are the exact opposite. These are things that are going to give you more confidence that the data is accurate and the people behind it are disciplined, right? So you can check out that the AR aging ties to the AP aging. When you get the financials, it's 30 days after month end, right when they told you it would be there, plenty of time to have everything reconciled, everything checks out, right? That discipline is going to set up the character that sets the tone for everything else that's going to follow in this presentation. Because if the data that they give you is not reliable, no amount of analysis is going to be worthwhile. And so this is a hypothetical example of how this might play out. Hot Mess Industries is a company that at first glance looks fantastic on paper. Their income is up 18% year over year. Their working capital ratios look great. Receivables balance looks really healthy. And they were really quick to hand over their financials, like very quick. As soon as someone asked for them, 5 days later, there they were. Everything looks great. I know what you're thinking. Love it. We all love to see that. Unfortunately, though, when we dig deeper, we start to see that things fall apart. The first red flag is that retained earnings did not roll correctly. If you recall from the very first section that we did in this series, retained earnings, and we'll talk a little bit more about retained earnings later in this section as well, is kind of where the company's, their financial performance, where they ended at the end of the last period that they gave you. And to this year, the starting point has now changed. For whatever reason, they're now saying that they're starting at a different place than where they ended last year. That is a huge red flag, right? That is essentially, they're not giving you consistent information year over year. How could this year's starting point be different than last year's ending point? That is sometimes a way that companies try to hide current year expenses in a place that you might not be looking, which is last year. Whether it's on purpose or it was just an accident, that's not a good sign. It's definitely not a sign that something was verified, validated, and was prepared with good discipline. Then we notice that the financials are dated February 15th, 2025, not a month end. So that tells us that the numbers likely were not tied to a clean close and the numbers have not probably been fully verified. The AP aging was missing about $60,000 between the aging and what was on the financials. They just left that off of their listing, which is very strange because expenses don't usually disappear, but they do sometimes like to hide. And then we found that 30% of their receivables were over 90 days, and the WIP schedule, those WIP adjustments were not recorded. Those WIP adjustments, they have a significant impact to the financials and to the profits. And that entry being missing immediately calls into question the reliability of the company's revenues. Add to that, when we asked about what are these 90-day AR invoices, as it turns out, oopsies, we shouldn't have recorded those. Those were errors. They should have been removed. Now we have an even bigger revenue overstatement problem. So what this really meant was that the company was changing numbers in a previous years, didn't have good, habits there, not very consistent. They were skipping reconciliations. They were overinflating income through erroneous billings. And who knows where that 60K of AP went. On paper, very strong performer, things that we love to see. But in reality, that was all based on unreliable data. So there's no reason to do any additional analysis or benchmarking with the data that they provided because the data itself is telling a very inaccurate story. So hot messes look great on paper, but it's important that you pull back the curtain and kind of do your own those quick verifications, that 15 minutes or less to kind of go over whether or not things tie out, whether or not they have good answers to quick questions that you might ask. Because even though ratios might look strong, reports come in on time, the owner could sound totally confident when you're asking them questions. That might give the appearance of something being low risk, but it's important to just kind of, before you invest a lot of time in all of the rest of these things, like just kick it around a little bit to make sure that the accounting is in tune. In this case, the numbers may not be wrong because of fraud or anything nefarious or someone trying to hide something. They very well could just be wrong because of poor processes and inconsistency. And so once you're able to determine that a client is able to close their books consistently, reconcile fully, explain results clearly, then and only then do we move on to more targeted risk assessments and analysis. And so that is going to bring me to the end of this section on character. Before I move on to capacity, this is a great point or a great time to stop for questions. So if you have any questions about how to validate data, how to kick things around, or kind of know if your client's data is trustworthy, this is a good time to put it in the Q&A.
Heather, I do have a question actually from another one of our panelists. They were curious if you could show us where the AR and AP are on the balance sheet to match what they show on the aging reports.
Ooh, you know what? If you go back to section 1, I don't have those slides like quickly to be able to pull up. I will try, let me see if I might be able to, let me see. I can show you that. If you go into section 1, where we had like copies of the balance sheet on there, let's see, where we had, it'll be like on the balance sheet. So the AR is like a balance on the face of the balance sheet. It's really obvious. Let's see. I think it should be in here. Okay. Let's see. Okay, so it will be right here. So accounts receivable net. So it's going to be like can you see that part of my screen? I'm not sure if you can see. You see the slides? Okay. Mm-hmm. So it's going to be one of the very first assets listed in the balance sheet. And whatever form the AR aging takes, it's just a list. And it should have like, here's all the people who owe me money. Here's the balances of what they owe, and here's how old they are. That number on that whatever detailed schedule and however it looks should tie to the number that is on the face of the financial statements. So they should have essentially a detailed listing of what makes that balance up. And same thing for AP. So on the liability side, AP is this guy right here. So the accounts payable, same thing. This should have a listing behind it that of all the money that they owe to people. And so, they should be able to provide that. And that listing should have this, there shouldn't be two different numbers of what accounts receivable is or what accounts payable is.
Perfect.
Does that answer your question?
Yeah, it answered the question.
Okay. Awesome.
And I don't see any other questions at this time, Heather. So if you want to move on.
Okay, I will. All right, so now we know we can trust the numbers and we can use them to our advantage. And that now brings us to how to test for capacity. Every company wants to grow fast, take on more clients, expand their reach, and we want to help them do that. But the real question is going to be, Can their financials back it up? So we evaluate benchmarks relating to capacity to differentiate between ambition and ability. We would love to support every contractor, every company, whatever industry that they're in, who thinks that they can get more work, bigger contracts, go out into a new market. We'd love to see them expand. Ambition is what drives their progress and what makes them successful business owners. But that ambition also stretches cash flow, stretches their systems, and it also stretches their leadership. So from a credit perspective, this is where financial red flags start to show up. You might see unbilled revenue start to increase. You might see accounts receivable collections, not being as fast as maybe they once were if they don't have enough people to chase it down, or they're just kind of throwing billings together. You start to see that AR stretch or working capital tighten. And even though revenue is increasing, you start to see these other measures of capacity, their working capital and like what they actually have access to, start to signal that the growth is outpacing the company's ability to manage it. So red flags here are not always about bad decisions. Sometimes they're just about someone moving too quickly. They're about speed. When a company is chasing opportunity without a good process behind it, without a good team behind that, that team will get spread too thin. And when that happens, oversight slips and leadership loses sight of their true cash position, right? If we don't have enough people watching the water, that's where, a little bit extra expense gets spent here and nobody notices, and all of a sudden our margins get eroded, right? This is kind of how the red flags start to develop. So that's how your margins kind of start to compress. And when margins compress, liquidity dries up and the problems start brewing. On the other side, the green flags, those look like disciplined growth. You'll see stable margins, right? Like even though revenue is increasing, the margin's kind of going with it. Or you see consistent backlog reporting, strong working capital trends. These are signs that a company knows when to push into a new market or into expansion, but they also know when to slow down to reinforce their foundation. So the takeaway here is that capacity shouldn't always be determined by the amount that a client wants, but rather how much can they handle responsibly. And as long as the financials are showing consistency, scalability, good control, then that's when you know that growth is sustainable. So how do we evaluate that? Of course, everybody wants as much capacity as they can get. That is natural. But nobody ever went out of business because they had too much cash. The opposite, however, is unfortunately true. So that is why when we're looking at capacity and how much risk to be, a client can take on, we're looking at metrics around cash flow and resources available to support a company's operations. On all of the benchmarks that I am providing today, I have how I typically calculate it as well as the targets that I use. But if your organization has a specific way of calculating something or a target that you use that. That is totally fine. Like accounting gives us lots of ways to kind of do things. Just make sure that whenever you are doing a calculation or a ratio, that the calculation is done consistently. So that way changes are because of the client's data rather than a change in the formula that we're using for the ratio. All right, so the first common benchmark here is EBITDA. This one is really common. You see this a lot also in like the mergers and acquisitions world. You'll hear this word kind of thrown around a lot. And that's because this is sort of like an income statement estimation of operating cash flow. EBITDA tells us whether the company is consistently generating earnings from operations. So if we're seeing large swings in this number, that can indicate instability, difficulty scaling, especially as operations are getting larger and getting more decentralized. But it also can just mean that the company's books are, inconsistently closed. If we see peaks and valleys, there are a lot of accounting rules specifically designed to prevent roller coaster accounting. And so if you're seeing roller coaster accounting, it means that they're probably missing a few steps in their month-end close. The next one is quality of earnings. We talked a little bit about this in section 1 as well, and quality of earnings is one of those metrics that I feel like should be talked about way more than it is. Ever since the Enron debacle, this is a ratio that has been said would have actually caught that Enron was in trouble way before it actually got caught that it was in trouble. And so quality of earnings is a comparison of how much cash the operations of a company is bringing in as compared to their net income. What this is doing is checking whether profit is supported by cash flow. Strong conversion of profits to cash flow is a sign that the numbers are real and they're not just paper profits propped up by aggressive estimates. Again, nobody went out of business because they had too much cash. So converting revenue to cash is like the one and only most important thing that a company can do and still be a company. The next one is working capital. So working capital is a measurement of liquidity, the company's ability to meet their short-term obligations. If this number starts to trend down, then that means that there's less funding available outside of what has already spoken for in terms of bills that the client has to pay already. So when we start to see compression in working capital, or we might have thresholds that a client needs to maintain in working capital, we do that because that is an early warning of cash strain. And again, can you fund your growth? That is all a measure of like what resources you have available. The current ratio is very similar to working capital in that it is still a measurement of liquidity, but instead of kind of calculating an amount of liquidity, we're looking at the balance between the assets and the liabilities. If we have a ratio where this becomes too low, that could signal an issue where we don't have enough of a cushion should something unexpected arise, right? When I'm thinking of financial statements, especially from like a credit perspective, I'm always thinking of, if someone doesn't have the most conservative approach, they're probably most likely to overstate their assets and the good things. And they're maybe a little bit less likely, or maybe, they're not going to mention all of the bills that they have. So if I'm thinking of my risk, the risk is that the working capital, they're going to be trying to show as much as humanly possible in these financials if they're trying to be aggressive. And so you want to give some cushion in your current ratio. Sometimes you'll see the target set at like 1. And that means, anything over 1 is that your assets exceed your liabilities. I like to kind of look at that cushion being a little bit higher because I know that the bias is usually to inflate those assets and kind of underplay those liabilities. I want to leave even more cushion so that in case there's a secret liability sitting out there, we can cover it. And so together, all of these benchmarks are going to tell a story about a company's ability to sustain their growth, manage stress, and maintain control. So this slide is going to kind of help translate those ratios and those numbers that we were just talking about into what they actually mean from a surety's point of view. So again, red flags here, they don't automatically mean that something is wrong, right? We can have a couple little red flags next to a pile of green flags. That's okay. But these are signals that risk is starting to increase, or maybe information needs a little bit of a follow-up. So if our EBITDA margins are declining while revenue is rising, that could mean that the company's growth is stretching operations or bidding too aggressively. Or if our working capital or our current ratios are slipping, that could point to like short-term borrowing or delayed payables. Like maybe they're not able, they're having a little bit more trouble with their liquidity. Large or repeated underbillings often tell us that cash is tight because they're recording these revenues, but they're not actually billing them, and thus we can't collect them. They are playing, their clients are playing with their money instead of the other way around. Those also can be a sign that revenue is being recognized too soon. Green flags, on the other hand, show the exact opposite. So these are going to be indicators that the company has balance, process, discipline. They're kind of, monitoring, they're keeping an eye on these things themselves. They have their own cash flows that they're monitoring, etc. Consistent margins, good cash flow that's aligned with earnings. As earnings grow, so does their cash, so does their working capital. Timely billing, timely collections. Those are all signs of a company that knows its limits and can stay within them. And I wanted to specifically talk kind of in this section about deferred revenue because unbilled revenues in whatever industry are a problem. This can be a problem. This is one of the easiest places for financial statements to look really good on paper and hide real risk. And that's sort of why they say that quality of earnings ratio would have kind of signaled the Enron debacle before the Enron debacle happened. It was because of unbilled revenues that were not converting into cash. So these unbilled revenues can represent just pure timing differences. Things happen, of course they do, but they could also represent issues where they're reporting revenue that they cannot bill for whatever reason. The client won't approve it. They're in a dispute. The contract's not even signed. Ultimately, it's a sign that the company is spending more money or spending money faster than they are able to get paid because they're doing this work, they're expending those expenses, and they're not able to get paid for it. So when you see underbillings, contract assets, deferred revenue, unbilled AR, these are all signs that, those are all examples of this. And the question that you should be asking is not necessarily, is this bad, but does this number make sense? And so you would do that by kind of asking for the detail, or what are these unbilled AR amounts? And if the client can clearly explain like the exact situation that has caused the underbilling, maybe it was a delayed client approval, something that happens infrequently. Maybe they accidentally missed a billing cycle. These are usually fine, like one-offs. This is not a systemic problem, and the client knew exactly what it was and they were like actively working on it. That's okay, because they know their jobs, they know their process, and they're staying on top of it. But if you see that this balance is lingering, or the client can't describe what caused it, that is when your risk is increasing. It could mean unapproved change orders, billing disputes, aggressive revenue estimates, some reason that this client can't bill this work, and it happens a lot. That should get your mind kind of thinking. And so one of the best questions that you can ask when you see these deferred revenues or unbilled AR, contract assets, is how much of this has been cleared since period end. So if they can show that, their February underbilling now in October is totally resolved, they got it billed the next month, everything's good to go. Perfect. That's a great sign. The problem is when things are more pervasive, or they last, more than a couple months, and that things continue to remain underbilled or unbilled, that you want to start like kind of putting your spidey senses up. So not all underbillings or contract assets are bad, but the unexplained, systemic, pervasive ones, those ones can be an issue. So we're going to put this all together by looking at Ambitious Inc. On paper, this company looked great. Revenues up 25%, margins were strong, backlogs growing, ratios, working capital, all look good. From the outside, it looks like a strong growing company ready for a bigger bond line. When we dive deeper, though, unfortunately, yet again, the picture changes. When we're comparing our numbers from the last financial statement they gave us to the current, we see that underbillings had increased more than 40% in just 6 months. That is not the right direction for unbilled revenues. When you ask the client about it, they don't really have a good reason. They don't have a reconciliation. They just sort of say it's timing, and they know they're going to work it out later. They have a declining quality of earnings. That's that cash flow, how much of their net income is converting to cash. That is on the decline. And so that's a sign that cash flow is not coming from their operations. It's got to be coming from somewhere else, or their revenues are not converting to cash. very in line with those underbillings. Declining EBITDA is an indicator that these new divisions that they're entering and are driving their growth, maybe they don't have as experienced managers or good cost control as this company is growing and decentralizing, because the EBITDA margin as revenues are increasing, starting to slip. And ultimately, what this means is that the company is growing faster than the support systems behind them. Perhaps that unbilled AR is purely because they don't have enough people to bill the work that they have, right? There are the actual systems that support that growth are not able to handle the work that they're doing. And so they're at risk of taking on more work than they can reliably fund. The financial strength was not based on their ability to go out and win work, but instead on converting that work into cash. So they're running on credit and unbilled work. The takeaway for sureties in this kind of a situation is that this client didn't really need a bigger bond line. They needed time and structure to like stabilize their foundation. So the underwriting questions here might shift from, can they get more work? Are they going to get more work in the future? To instead, can they handle the work that they already have? Because at the end of the day, growth without control is going to add to risk. And when that risk shows up, it shows up in the financials long before it shows up in the performance. And so with that, I am done with this section on capacity. So if you have any questions about the benchmarks that we talked about in evaluating working capital, cash flow, and a client's, ability to fund the work that they have, this is a really good time to put that in the Q&A before we move on to capital.
I do have another question from one of our other panelists. The working capital and current ratio would be nice to see on the balance sheet to help visualize it. Is that ever a thing? Do balance sheets ever include that information?
It is not like explicitly. So on the slide, I kind of have like right here, like the current assets divided by the current liability. So the current assets minus the current liability. Like this is sort of the roadmap to how to get it from the financials that the client is providing. So for working capital, current assets minus current liabilities. These are totals that are always on here. They should always be. If someone who knows what they're doing will always provide totals for those, because we know how important these metrics are. So in this client's case, their total current assets was 89,000. Current liabilities was 61,000. The difference between those two would be their working capital. And so kind of in all of the benchmarks that I'm providing, I try to kind of give you like a roadmap. They're not usually, especially in like a CPA reviewed financial, they're not going to be in there. But all the ingredients are, right? So for EBITDA, you would grab your net income that's a total on the income statement. Like these are all items that you should be able to find as separate totals on a financial statement. So like for like this EBITDA, net income, interest expense, depreciation, let's see. Like here's your interest expense, here's your net income down here. Like these are all things that you would kind of, you might have to hunt and peck and find it. But again, anyone who's doing financial statements, especially the CPAs in their CPA reviewed and audited financials, we know that these are the things that people are looking for. And so we will have totals for these different categories.
Thank you.
Are there any other questions?
I don't see any other questions at this time. If you want to continue, guys, feel free to ask questions throughout. We'll get them answered for you.
Awesome. I know we have email and stuff too, but it's kind of nice. Like if you have a very specific question, like this is your chance, right? To kind of go through it live. But yeah, so we'll move on to capital. So we've talked about capacity, the drive to grow, to take on more work, but growth is not the same as strength. To sustain the growth, the company needs capital to support it. So capital is going to be the financial cushion that allows them to handle surprises, delays, downturns without relying on debt. It's like their own internal bank. And so we evaluate capital related benchmarks to understand how much skin in the game do the owners have. If a problem arises, are the owners the ones who are at risk, or is it a bank or a surety or someone else who is going to be left holding the bag? The more capital, the more skin in the game that the owners have, the less likely they are to bounce when things get hard. So capital is what gives a company staying power and its resilience. It's not just about how much money they have made, like profit, but rather over the years, since its inception, since the very dawn of its existence, how much of all of the money it's ever earned have they kept and reinvested back into the business versus taking it out and distributing it to themselves or paying themselves big bonuses. So a company that has good, strong capital has room to take a hit without panicking. They can fund jobs while they're waiting for AR to come due. They can handle things like a government shutdown where maybe their receivables are taking longer to be received. Those delays in client payments, they're not going to need to rely as heavily on short-term credit to keep them going if they have a good, solid foundation in their capital balances. So red flags in capital would be when debt is rising faster than equity, or when owners are drawing out more cash than they're reinvesting in. If they're just harvesting the cash out of a company, it doesn't really bode very well to them kind of trying to keep some skin in the game. That tells you that a company is eroding their safety net. On the other hand, green flag companies are where the profits are retained. Equity is growing. Leadership is really focused on long-term stability rather than short-term personal gain. And so these are some of the key capital benchmarks that we use to determine if a company could sustain itself through a downturn without outside help. The first one that's very popular is debt to equity. So that's total liabilities divided by total equity. And I'm going to show you, I feel like it's good to kind of show you on here. This was from our last presentation. So this is the total liabilities. This will always have, this usually, actually it doesn't necessarily have to, but it usually has a total liabilities divided by total equity. So how much more are they borrowing? In this case, 481,000 is borrowed. My clicker does not like to click in here. 481,000 is being borrowed, and the stockholders are only funding 289,000. So they're borrowing more from banks than the owners have skin in the game. That is kind of the measurement that we're talking about when we're talking about the debt to equity ratio. And it's important because this shows how leveraged the company is. In other words, how much are other people going to be coming after the company's assets versus how much are the owners putting into it? If debt is already high, then there's no room to borrow when cash gets tight. This is a very common ratio also for banks. And so other people in the underwriting field tend to look at this to kind of get a sense that if the client were to get into trouble, would a bank lend to them? If there's no room to borrow when cash gets tight, then we start to see companies getting in trouble when, slow pay cycles or when cash gets tight. Working capital versus revenue growth. This is about growth discipline. As revenue is growing, right? As they're getting to be bigger and bigger companies, working capital should be moving right along with it if they're growing proportionately or responsibly. If revenues are growing faster than working capital, then that means that the company is outpacing their ability to fund that growth. Very similar to what we were just talking about in capacity. But When we're talking about it in like the capital, the sense of capital, it's because they are distributing, they're bonusing, they are not saving that working capital. Like their revenues are growing, they're not reinvesting it back in the company, they're ripping it out, they're harvesting it to use, outside of the company. And that is what we want to avoid. We don't want to erode that safety net. Because when that spending is outpacing, they're going to end up having to use borrowed cash or stretching their payables in order to keep up. Like if they're taking all of the excess out, if trouble hits, unless those owners are prepared to put that money back in, they're going to be stretching. They're going to be, pulling on that working capital. And again, nobody went out of business because they had too much cash. If all the cash got taken out by the owners, what's left, right? So we want to see that working capital staying in the company as revenues are growing. The next one is retained earnings. This is just a balance sheet line item all on its own. But it's like one of the most important balance sheet line items. It's right here. There's no formula for it. It's just a line on the financials. And this is a long-term indicator. That number in and of itself, like the very definition of it, is all the profits from all the dawn of time that have retained in the company. They have not been distributed. They have not been expensed out as a bonus. They were kept by the company. So retained earnings is the company's shock absorber. When times get tight, this is what helps them stay stable. Flat or declining retained earnings, if revenues are increasing, that is a bad sign because like all of the profits ever retained, if you have more revenue, you should be having more profits retained. If they're not going together, that is a problem because it means that the owners are over distributing. They're taking the cash out of the company instead of reinvesting it and creating more of that safety net. And kind of in that same vein is the distribution policy. So this tells you a lot about leadership mindset. There's two ways that people can get money out of a company: through the regular income statement process, income statement, their expenses, their bonuses, their payroll, their invoices. The other way is owners can just take it out as a distribution. So it's important to look at what the owners are distributing to themselves when you're looking at the financials. So are they taking all of the profits that were just made in the previous year? Are they distributing? Are they taking that all out for themselves? Or are they leaving anything to help prop up and support the future of the company? So capital strength, these ones are not about like hitting a perfect ratio. I mean, sometimes there might be like debt to equity ratios in loan agreements and things like that. But this is really more about understanding that character of your client and like what is their consistent pattern. Are they exhibiting a pattern of discipline, reinvestment, kind of putting that effort into growing their foundation, or are they eroding it? And so these are ways for you to be able to spot whether a contractor is forward thinking, long-term driven, and trying to build endurance, or if they're burning through their safety net. So this slide breaks down what red and green flags kind of look like in practice. On the red slide, you'll notice themes of instability, which increase risk. Even if you're not actually calculating the ratio, but you can just start to see like rising debt. They're going into more debt to pay their bills, right? They're borrowing faster than they're building value in their equity. Working capital that's lagging behind revenue, showing growth that's not self-funded, or the owners harvesting that cash away. They are using other people's money to operate, or the owners they're using the company's money to operate whatever is going on in their personal lives. Retained earnings that are flat tell you that profits are not being reinvested into that nice corporate cash flow cycle. And when you see cash reserves drying up or the balance sheet swinging wildly from quarter to quarter, that is a sign of poor planning or reactive management. On the green side, you're going to see themes of discipline, things that mitigate risk, right? Leverage is stable, capital is growing steadily, cash flow is supporting their operations without constant borrowing. Working capital is like in line with sales. So the company is funding their own growth. And retained earnings are accumulating. That is normally what you see. You should see retained earnings growing from year over year, where a company is keeping what they earn to build long-term strength. And their financials should be consistent period over period, where changes are explainable and supportive. That shows that the company knows its numbers, they're managing proactively, and they're not seeing a nice big juicy profit month and taking all the money out for themselves. The goal here is to evaluate not just the profit and the top line or their revenues, how much they made this year, but how much they retain and keep in their control. So we got another one for you. This is generous holdings. They look great, steady profits, low debt, solid margins, conservative reputation. It's really the kind of company that you might look around and say, this is a dream client. They're debt-free. They've had really great years and they really just need a higher bonding capacity. And I know everyone is probably thinking right now, no, Heather, don't take this one from us. But sadly, I am. We're going to dig deeper. And we find that this client's issue was not about their earning capacity. It was about their retention. They're retaining it. So this company, when we kind of dig under the hood a little bit, we see very high owner distributions, which equal or exceeded the amount of their net income each year. They are taking everything out of this company that they can. And in an attempt to pay less taxes, the company was spending or distributing almost everything that they could that they had earned, leaving very little in reserves to support future growth or absorb risk. And this is where the capital ratios are like going to kind of tell this story. The debt to equity, it looked conservative, but in reality, that was because the debt was low, not because the company was reinvesting its profits. Owners are taking all this money out, funding their side ventures instead of strengthening their balance sheet. So equity, the retained earnings, is not growing. It's flat for 3 consecutive years. And we don't see new investment in equipment or accounting systems or people. They're trying to do this expansion without any additional resources being retained in the company. Ultimately, those are all signs that the business was running on yesterday's infrastructure while trying to compete in today's market. So even though like the ratios look like the current year activity look good on paper, they're not as structured or stable or able to absorb a hit if something were to happen. And so, in the event that there was a downturn, they had income, but what they didn't have is a safety net to pull from in the event that they needed it. So Generous Holdings in this case did not need a bigger bond line. They needed to keep and reinvest more of what they earned. And with that, I am done with the capital section. If you have any questions about how to evaluate skin in the game, things like that, now is a good time. I don't see any. Kendra, do you have any?
I don't see anything at this time.
All right. All right, we are in the home stretch here because there are 5 C's of credit and we are getting to number 4. And this is a very short section because good news, collateral it goes, it's what they've kept, but also what they have access to. And luckily, we test this the same way that we test capacity and to some extent the capital. So, those other things serve double duty. But the difference here is that when we're thinking of collateral, we want to assess whether or not the financial statements are supporting collateral. So can you verify that the things that they are telling you in those other sections that we talked about, do they actually exist? Do they have value? Is that value the same value that they told you it was? And can they access it if something were to go wrong, right? So if they say that they have a certain amount of marketable securities, is that really the value of those securities? And do they have access to them should something happen? So the indicators here are going to be very similar to those, in the previous sections. It's almost like all three of those kind of roll into this one. Their credibility in their process comes into play a lot here. You're looking for them to have a good quality month-end close process that is verifying that the balance sheet is tying out to actual existing sources, right? Bank reconciliations, marketable security statements, like these are real supportable numbers, fixed asset schedules that support their equipment values, or an AR aging that agrees to the underlying billings. Those are all things to really test like the validity of their assets. If your asset balances cannot be verified quickly, or if collateral is tied up in illiquid assets like real estate, that is going to increase risk. I mean, it's still better to have real estate than to not have real estate. But if they get into a bind, having to sell real estate versus having to withdraw from a checking account are two different, they're two totally different things. So another sign of weakness is when equity appears strong, but it's built on estimates or unsupported balances rather than hard liquid assets. So if we kind of go back to that first section that we talked about, and here we have our assets going in order of liquidity, right? Cash is the best. Cash is queen here. Our investments, we're kind of going down. Somewhere down here, we've got prepaid expenses. Like if things hit the fan, we can't, that's an asset, but it's not a liquid asset, right? And so if these are based on estimates, if their inventory is not supported by an actual inventory log, it's just based on vibes, that is not going to be great for your use in collateral. So the more we have like more liquid, hard, verifiable assets, the better their assets are for your evaluation in collateral. And so when I get questions from sureties, or when I've seen benchmarks and analytics that sureties have prepared, oftentimes they remove contract assets or unbilled AR or unbilled revenues from their calculations when they're determining what kind of collateral a company can support, because those are unverifiable assets. So on the flip side, we have our green flags, and those are the companies that do maintain updated reconciliations. They can produce supporting schedules immediately when you ask for it, and they are aware of their collateral and they align that with their bonded exposure. They don't take every dollar that they have and throw it into a piece of land. They hold marketable securities or investments, and they put the money to work, but in a way that is still liquid, because we want, they know that should they need it, they're prepared, right? And so those types of companies are going to be the green flag companies. So in short, we test this very similar to how we test character, capacity, and capital. But instead of like just looking at assets as a whole, you really want to kind of just gauge the quality of the assets that they have. All right, so once we know that the company has real assets behind the numbers, the next question is, how do they perform under pressure? Conditions are where we're going to look beyond this company, and we're going to look at like their entire environment that they live in. How does this company perform in the market and the economy? So conditions are, the industry, the economy, the overall ecosystem, and all of those competing pressures, their competitors, the price of their materials, all these outside forces. A perfectly run company with all the most amazing metrics can still struggle if they're in a really hard economy, right? So it's kind of now stepping outside of the company themselves and looking at the world around them and how they respond to it. So if margins are tightening across the industry, it might not be so unusual to see margins tightening at your client. It's almost like the financials that they give you is a dot in the center of a graph. And all this other data and industry information provides all the trend lines that help you to understand what that dot means. Is that dot high? Is it low? Getting to know the conditions, the market, and the economy is really going to help with that. And so if the margins are tightening across the industry, if backlog is concentrated into one singular market, or if the company is chasing riskier work in order to stay busy, those pieces of context start to change how we read the financials and the numbers. If we're looking at that and then we're looking, we kind of understand like, they're doing some riskier stuff. We might need to make sure that we've got some good capital to protect us if those risks do not pay off. And so you kind of want to make sure that leadership understands the environment and that they're staying competitive within their industry. Are they watching things like labor availability, materials volatility, demand shifts in their core markets? Red flags are going to show up when the company ignores those external pressures and when they overextend themselves during a boom, or they fail to adapt during a slowdown. They just kind of put their head in the sand and keep operating business as usual, even though the world around them is not business as usual. So it's important to not just look at the client, but what are their competitors doing? Are their competitors performing at a certain level? And if so, is the client also performing at that level, or are they falling behind, or are they keeping up? Green flags in this area are when management is like, they're on it. They're ahead of the curve. They're going to CFMA meetings. They're going to industry events. They know what's kind of going on in the world and they're looking ahead, right? They're pre-buying materials because they see tariffs are coming, or, they're diversifying their markets. They're balancing their backlog. They are using their financial data to forecast and to prepare. So conditions are all about context, and they answer how stable is is this company when the world around them changes. And so these are benchmarks that are going to take us through measurable trends rather than instinct, narrative, and vibes. So months in backlog is going to measure the pipeline. This is like their sales pipeline. When the pipeline is consistent and booked several months out, it shows stability. But if backlog is shrinking or it's inflated with unawarded bids or fake, things that haven't quite been inked yet, then that would be a signal of uncertainty. A declining backlog is not necessarily a problem, but it is kind of like seeing storm clouds in the forecast. It's not time to panic, but it is time to keep an eye out for liquidity and short-term debt. The next one is customer and market concentration. And this one is one that I do see some sureties asking about, but I think it's very, very important, especially in the current market that we are in today. Conditions, the pressure that is put on a company can come from its own internal pressure, but it can also come from an external source. And if that external source is responsible for a huge part of their company, that is a huge problem. So when too much work is tied to one customer, one trade, one geography, a single event can be huge to this company. It's kind of like, the current government shutdown. If you have a company that is doing all of their sales with the federal government and the government shutdown causes delays in projects or starting, when the project starts or the payments, that is going to have a much bigger impact on the company than if the federal government only represented a small diversified portion of their business. The lack of diversification puts a lot of power over the company in someone else's hands. Now, I put in here a benchmark that you could do. And if you have clients who have CPA reviewed or audited financial statements or compilations with footnotes, this is a disclosure that CPAs are required to evaluate. But without that, this is also things that you can just know from your conversations, right? When you're talking with them and getting to know them and where they get their, where their target market is. If they are like working, they're doing everything with one particular customer. If something happens to that customer, now you've put a whole lot of pressure that had nothing to do with anything that this company could control. So the healthiest companies are going to spread risk across lots of different clients, lots of sectors, so that no one change is going to put them under too much pressure. And then we have industry and peer comparison. This is one of the most powerful tools for a surety, and why consistency is so important, and why it's so important to know how much effort your clients are putting into their financials. Because if they're doing their numbers the same way as the people, other people who are reporting trend and industry data, then that means you can compare their numbers to industry and trend data. And so I think like there are lots of different organizations that will allow like they publish these trends. So they'll put out, like CFMA will have their benchmark builder, or lots of different industries. And so I think it's very important, if you don't have your own industry comparison that you're using to kind of gauge how your clients are performing within these conditions, I think it's a really good thing to look into. And then the last thing on here, I have leadership and organizational resilience. Even the biggest market shift, what matters is how leadership responds. Strong governance and communication are, how companies stay steady when external conditions fluctuate. So this is really, again, not necessarily a benchmark that you can pull off of a page, but things to be paying attention to. Is your client always changing their CPA firm? Are they with the same bank for many, 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 many years? Have they been with their broker for a really long time and they're incredibly loyal? These are all things that weigh into, how the organization manages. Do they have their finger on the pulse of the industry? That would be a green flag. Do they have people who are quitting left and right and frequent turnover? That would be a red flag. And as sureties, you already know your clients the best. Those relationships are your greatest tool for context. And so lean into those relationships. Ask how the company is adapting to the market, how leadership is managing their risk. Like when you're seeing things out and about, or you're going to industry groups, or you're taking information back to them, get a feel for them, how they're benchmarking their performance against peers. Even if you're not able to do it, or you don't have, all the same benchmarks that they have, find out if they're doing it. Because if they are, that's a green flag. They're ahead of the game. When a company is aware of their surroundings and they can explain what's happening behind the numbers, and how it relates to their, the market, that should hopefully give them credibility and help you build confidence that they understand their business and that they are managing it intentionally. Reliable information is coming from reliable data. A lot of that also can come, not just from their internal financials, but from CPA prepared financial statements. When your client is giving you a CPA prepared financial, you know that the person preparing it is experienced with generally accepted accounting principles. And again, that should give you more confidence that what you're seeing reflects reality. And so consistency and transparency, these are going to make the difference between just a regular financial report where you just see numbers on a page versus a financial story that you can interpret, you can read, you can analyze, and you can compare to the industry to get so much more information about how well this company is doing now, how they've done in the past, and use that to make assessments about their risk in the future. And lastly, I was doing a presentation once many years ago with a banker who said that there is a secret sixth C of credit, and that is credentials. Credentials like the CPA and the CCIFP, those don't just represent letters after a name. They represent like ethics and education and technical accuracy, just like many of you who have credentials after your name. And I know from my own experience, even though I'm not in the public accounting world anymore, I'm on the private, accounting side. I am much less willing to stick my neck out to do something unethical because I have licenses on the line, right? And I think that it's really important that as sureties, when a company, like to recognize when a company surrounds themselves with qualified professionals, they're investing in controllers and CFOs who have verified experience in accounting, like that should build some credibility because they're investing in reliability and consistency. When clients are investing, like reviewed and audited financial statements, those are not cheap. And by doing that, they're trying to add an independent layer of assurance that the numbers are tested, consistent, and comparable. So for a surety, that means less uncertainty, hopefully fewer surprises, and more trust that what is on paper reflects reality. So as CPAs and CCIFPs, we are trained to apply GAAP, generally accepted accounting principles correctly, identify inconsistencies, and ensure that the financials being shared with you paint a realistic picture of what's happening. By investing in strong financial teams, that's kind of trying to make that investment into those financials for the future. So with that, I am done. But before I take my final bow, I wanted to open it up for any other questions. So go ahead and use the Q&A feature, or Kenda, if you have any.
I don't have anything on my end. Any questions can be put in the Q&A box. If anybody has anything for Heather. Heather, while we're waiting for anything to come through, I just want to say thank you so much for putting this together and for all of the things that you've done for us. I do have a question that has just come through. So thorough and easy to understand. Well done again. Thanks a million. So again, Heather, thank you, from all of us that have learned so much, and you're easy to understand. So we just certainly appreciate everything that you've taught us through these series. So, and Fariba's not here to thank, but Fariba couldn't make it today, but she's been a huge part of these as well. And we do want to invite you guys back and please keep an eye on the Women in Surety website for future webinars that we will host as well. We look forward to putting some other webinars together with Heather and Fariba and some others as well around financials and some other stuff as well. So again, thank you everybody for your attendance, and we appreciate each and every one of you for being here today.
Awesome. Thank you, everybody. It was really my pleasure. And if some questions come up, of course, I believe these slides or an earlier version of these slides, I believe that these all got emailed out, but I will email out the the current final version. I did make a couple tweaks here and there. I'm terrible at editing things out, and I'm always like throwing more stuff in. So I'll make sure that these get out to everybody. But if any other questions come up, please feel free to email me. My email is here on the page. That's my actual email, not my, public facing internet email. So you can definitely get me on this one. So thanks for the opportunity to talk to you guys. I hope that it was really informative, and I look forward to the next one.
Awesome. Thanks so much again, Heather. Have a great day, guys.